The Consumer Bankers Association is pleased to welcome you to today's webinar, How to Optimize Down Pricing in a Falling Rate Environment, presented by Kiranos. My name is Isabel and it is my pleasure to facilitate today's event. Thank you for joining. Please note we are recording and all participant lines are muted. If you have any trouble, please email conferences@consumerbankers.com or send a message in the Q&A box. This presentation will last up to 60 minutes and will include question and answer opportunities at the end. You may submit a question at any time by entering the questions into the Q&A box on the bottom of your screen. As a reminder, the views expressed in this webinar are those of the presenters and do not represent the views of CBA or its members. It is now my pleasure to introduce our speakers, Peter Serene, Managing Director at Kiranos, and Bob Warnock, Managing Director at Kiranos as well. Peter and Bob, welcome.
Great, thanks. So for those who are unfamiliar, we assume a majority of you are familiar, but we conduct advisory, data analytics, and pricing optimization exercises for a majority of the U.S. banking and credit union consortiums. We have a little over 50% of all U.S. deposits. I know it says 7 trillion up there in the upper left corner, but by the end of September, we'll have closer to 8 trillion following a number of signatures. So our insights continue to grow, as well as our pulse on the overall consumer level behavior across all lines of business. So as the industry has largely felt, we've seen a large portion of compressed margins and slower net interest revenue growth, which has led to suppressed returns for most institutions. You know, on the far left, we're kind of looking at the net income drivers that we have seen year over year, as well as the loan and deposits, the ROTCE, and the stock overall performance. You know, what this encapsulates is a near-term outlook where the banks themselves are priced for perfection. We have started to see a lot of expectations get built in for what should be the first quarter in over 6 quarters for higher net interest income across the industry. And this is as the benefits of increased, asset and security yields continue to remain elevated, and we see more and more institutions getting comfortable pricing down in a Fed rate environment. Now, with that said, we do say getting comfortable, there still is a fair amount of mix and IBD switching considerations that we believe and we'll discuss throughout this presentation that will pose a problem or at least an issue depending on your corresponding line of business mix. In addition to some of the big themes here, we are anticipating that third quarter will see continued stable fee net income across your businesses that are more exposed to it. We are expecting a higher sense of controlled expenses. We are also, as you've probably seen throughout the quarter, noting a little bit more of a higher provision for overall credit losses, especially with those names more skewed towards consumer finance. Now, the good news, though, is when thinking about next quarter, fourth quarter of 24, relative to fourth quarter of 23, we do foresee a better revenue and net interest income growth on the full year, as well as operating margin that does start to turn positive. But as we'll discuss throughout, this will require careful orchestration in your ability to pass some of the rate movement along to your clientele in a surgical manner.
Great, thanks, Bob. So as Bob has sort of set up, this is the Fed plateau has been hard for banks. Now we have a falling rate environment, and that truly is an opportunity. But it's not a sort of easy money in the bag opportunity. It's an opportunity where both position and tactics based on that position will really make a difference. So what we're going to do today is start with an overview of the position going into the falling rate environment. And then we'll move our focus into tactics for how to capitalize on the opportunities in the market today. So the first observation is that we've sort of stabilized into a low growth environment and a more stable operating environment in terms of the competitive dynamics and overall deposit balances. If you think about 22 into 23, you saw a pretty dramatic mix shift from traditional banks into direct banks that were generally faster to move on the way up. As we got into sort of the last innings of the rising and flat rate environment, you've seen a little bit of continued migration to direct banks, but gosh, it rounds to zero when you do the total balances to 1 decimal point. So we've sort of stabilized in sort of a range bound market that's in which direct banks command 21% of the total share.
Yeah. Oh, Peter, real quick. The one thing I'd add to this is just when we look at the overall direct bank sphere so far, we have not seen an overabundance of players cutting rates as the Fed cut last week. We're actually seeing that game of chicken really play out in live time, where we're not seeing that movement. What's going to be particularly interesting on that aspect is as money market funds away from the traditional FDIC walls have already started to see their yields compress. We did just see a pretty sizable outflow in the week over week data. Now, that proves out one thing, that 5% coupon really matters to a large portion of the customers who probably drove those flows. So we're not anticipating it'll be a tailwind for all retail deposits, but those who are still kind of fighting that game of chicken preponderantly on the large direct banks.
Thanks, Bob. The other thing that started to level off is the product mix shift. So we've sort of tripled in CDs as a share of total deposits through this rate cycle. But if you look just at 2024, we've largely leveled off at 21 up to 22% of total balances. I do want everybody to just sort of internalize these mix numbers a little bit as we think about the presentation, because sort of 22% in CDs, 43% in liquid savings, 35% in checking has a pretty significant influence on what the downward betas will look like. Each of those pockets has a distinct set of characteristics that will make them faster or slower to reprice, and also in the lower yielding pockets put a pretty firm floor on how much nominal repricing is possible in the context of the current rate environment and 50 basis points on the first Fed move. The first place we'll double click is the CD book, and a couple of things to point out here. The first is, as we think about sort of pricing to perfection and the timing of being able to realize some of the tailwinds from a falling rate environment, you are still beholden to a term premium in the overall CD book, or term structure rather. So banks have shortened up pretty significantly, but it'll take sort of a full 6 months to get through that sort of 60% of 55-60% of CD balances on their first renewal of the falling rate environment. As we'll get to in a couple of pages as we look at pricing, some banks have gotten ahead of this a little bit in starting to bring down CD rates, but there is just a timing element that we can't control for, and that's pushed out a little bit further, even in the direct bank books. The second thing to keep in mind is the rate at which these CDs are maturing. So on the traditional branch book, where our 12-month CDs are maturing at an average rate of 4.38. In direct, that's 4.97. Now, if you think about how that compares to the acquisition rates in the market today, the direct book is at 4. The traditional book is at 4.7. So we're actually rolling off CDs at a lower rate than the prevailing rate in the market, and the direct is essentially flat at 4.97 versus 4.93. Now, there are of course tactics available to bring down the price at time of renewal, but for those more rate sensitive customers that are actively reviewing and shopping their renewals, there is in the near term a structural headwind, actually, in terms of the traditional bank CD book, if you compare to sort of the current top of the market rates. Bob, anything you'd like to add on the CD story?
No, nothing at all.
Great. So as I mentioned, the recent action, even if the full 50 was sort of a split decision in the market, the notion that the next move would be down and it would be in September was widely anticipated, and a number of banks have already started to make efforts to bring down pricing a little bit ahead of the Fed. Where you see that most directly is on the left-hand side of the page here. That bar towards the bottom that has a bit of a dog leg down, starting really at the beginning of the year and has trended down ever since, is 500 basis point plus CD offers, and so what you've seen is essentially banks that have gotten to a stable place from a funding perspective, that are able to fund marginally through through very surgical funding plays in commercial, for example, have started to pull back a little bit on the most aggressive CD rates in the market. You haven't seen quite the same level of pullback on the liquid savings side, but what you see is sort of a much broader spread of top rate in the market based on how banks are positioning that product versus the CD product. So one of the questions we've received a lot in the last couple of days is who's moved so far? And as Bob alluded to, we have seen this sort of game of chicken a little bit, particularly on the very public direct bank rates. But the slightly more nuanced answer is, well, actually, a lot of banks started moving several months ahead of the Fed. Now, has this had a significant impact on overall portfolio rates yet? No, it has not, for reasons that we will address. But it is starting to get the ship sort of reoriented towards a falling portfolio cost. Bob, anything you'd add here?
The one thing I would add is, and it goes back to how we talked about line of business as a key contributor to what the retail bank can and should be contemplating, so they're not just working in a vacuum, is that when we look at some of the wealth strategies that are playing out right now, as Peter said, we have a very big barbell where we have seen a few institutions already pass along one or two price decreases ahead of the Fed movement, while there are others who have stayed top of market post the Fed movement and are using it as an opportunity to garner a deeper share of the wallet from customers who might otherwise have the notion to churn or some excess liquidity that they otherwise would also like to optimize. So the key thing here, though, is not only within your retail book are the games of optimization. You are working in concert with several pockets of money across today, tomorrow, and someday that the wealth group is also trying to compete with and taking a very different approach from a more intentional downward management move across retail.
Thanks, Bob. Okay. So if we turn now to the implications of the sort of top of market rate positions on the overall book, what we see is that about half of banks are still at their peak rate. If you look at the charts on the left side of the page, those black bars, which are 66% of liquid savings and 44% of CDs, are at a portfolio level still at the peak. The remainder is banks that have managed to start to bend that curve a little bit through a combination of lower acquisition rates and solid retention at lower renewal rates. Those are sort of the two key levers that we have to bring down those portfolio costs, particularly on the CD book. That said, if you look at how much of a difference this has made, it's pretty modest. So the vast majority the majority have moved the needle by less than 10 basis points. A little fewer than a quarter have managed 10 basis points or more. In the context of thinking about this as sort of getting ahead of at least 125 basis point cut that was in the minds of some of these participants priced in the July meeting, and then in the context of sort of a full 50 in the September announcement, these amount to relatively low betas if the bank doesn't do more. So if you sort of go in with the mentality that we've pre-managed the first cut, you're looking at sort of 10 to 20% downward betas for the portion of banks that have actually done that. Of course, there are half that haven't started the process. Bob, anything you'd add here?
No.
Okay. The other thing that we just want to touch on sort of position-wise before we get into tactics for how to manage this going forward is it is the most important, in some sense, the most important long-term driver of lower portfolio costs, an important structural driver, which is primary checking acquisition. And there are a couple of other things that are going on at the same time that we don't want to lose sight of. The first is the evolution in customer preferences, and particularly from a digital standpoint, the desire of customers across segments to originate and open their accounts digitally. That said, we have a very different trajectory in terms of quality that's coming through those channels, both in terms of initial balance, sort of fully funded balance at the 6-month mark, and then looking at 12-month retention. So this remains, as we think about the tactics, with one part of our focus, we need to be sort of razor sharp on how we're bringing down interest expense. But if we think about what we do with that, there's a part of it that drops to the bottom line to tie it back to where we started in the earnings recovery, fueling the earnings recovery through lower costs. But there's also a part of it that hits reinvestment, and that reinvestment touches both on the channels and the digital experience, as well as the marketing and personalization that we'll turn to next. But before we go there, Bob, anything you would add here?
Yeah, I would just add, and we did get a question on this too. In a down rate environment, should we be anticipating that the direct bank or branch-based retention will augment, i.e., skew up? Not anticipating that. The real differences between the brick and mortar and the digital channels go back to what Peter was discussing on the primacy side. But the one thing to take note of is that on the far left here, with the mass market and affluent, with both demanding the ability or preference to open digitally and service digitally, those journeys cannot be one and the same. Each of those cohorts will expect different levels of service, different levels of onboarding, touch points, as well as continued benefits throughout. So a one-size-fits-all does not really work here on the digital arm. And when we break apart these teal bars in the middle and far right column, while those are industry averages, there are best-in-class players that almost mirror the brick and mortar, and then there are also those institutions that lag significantly behind. And if we're just expecting the lower interest rate environment to fix lower churn or normalize the average balance, that won't play out. We still need to invest in what that particular onboarding journey looks like, while minimizing some of the upfront fraud onboarding aspects where warranted. we must obviously stay vigilant against it, but ensuring that we do have a wall that is optimized for click through, and opening the account and funding the account becomes paramount in a lower rate environment where there's not as much differentiation.
Great. The other thing that's the sort of big macro trend that's taking place here is the fragmentation or delamination of the consumer wallet. And what you see here is across segments, including small business, you've seen a pretty significant increase in accounts and financial institutions. So as you think about this, one of the implications of that, with more churn in the market, is intuitively more competition to acquire, frankly, a smaller share in many cases of those wallets that are in motion. And the way that that's expressed in the data is the acquisition cost per account, which have more than doubled over the last 4 years. And so as we think about this, there are really two important takeaways or two angles here. One is in terms of reinvestment of some of the savings that we're able to generate through down pricing the existing book, to pay for ways to improve the targeting and pull through of acquisition efforts. The other is in terms of a sort of dynamic balancing of portfolio costs between marketing expense and interest expense, and the implications from a treasury standpoint of the quality and stability of those balances that we bring in. So as we think about the next section we're gonna go to is so what do we do about it? Some of the reasons that we go and are more or less aggressive in our down pricing tactics are related to the performance of our customer and account acquisition engine from a primary checking standpoint. Bob, anything you'd add here?
Yeah, and I do believe that there's an aspect of how this has evolved over time. While we spoke about primacy up front early on, it was, unintentionally flippant, as everyone should understand what primacy is. In this case, we want to stress that one of the things that we are learning too, as the subject matter experts, is in parallel to what the industry is learning. Primacy is an evolving, living concept that each cohort of banking individuals, be it mass market, affluent, business banking, has a dramatically different approach to and statement or belief of what that constructs. And one of the interesting things that we have seen transpire throughout that evolution is this fragmentation of the wallet, which does have its pros and cons. One of the interesting things that we've been speaking about with the industry at large is the fintechs and neobanks are really struggling with this delamination. They've historically relied on direct deposit, as has most of the banking and credit union industry, to signify or signal a strong sense of primacy. But what we're noticing within the data is that we are seeing more and more ACH and debit movements in and out of accounts that suggest that just because you receive the direct deposit does not mean that that account itself is not just a filter to other institutions where a stronger sense of primacy or relationship depth might exist. So this is an interesting phenomena that has occurred not only within the most recent rate cycle and poses challenges to the down rate cycle, but started as early as 2018, if not prior. It was just that the sample size of those new accounts switching for reasons of primacy had not grown to a statistically large enough sample set for us to hit.
But Bob, we had a question that came into the box that's actually, I think, really nice into this topic. You touched on the role of fintechs and neobanks here. How does this work? How does this look different for smaller regional or super community banks versus sort of the large regional, super regional banks and the national players?
No, that's a good question, Peter. And let's anchor on the fintech, and we'll then go into small institution, mid-size, and large. So the fintechs primarily were very uniproduct focused. We have a single value prop, a single product, and it serves that segment's core needs. What's happened is, though, that segment has evolved beyond the capabilities provided by most institutions that have such a narrow sliver of the wallet, requiring them to expand out and capture additional opportunities, if you will, in other account structures that satisfy their monetary needs. Now, when we think of monetary needs and transitioning into the banking sphere, we think about it as today money, tomorrow money, someday money. That today money is your transactional, your primary checking, if you will, your payments account. Your tomorrow money is that excess liquidity, your savings, maybe some CDs, and then your tomorrow money is really that wealth or excess savings component, maybe a high yield, maybe an MMDA or an MMF, or other asset vehicles. Now, the smaller institutions have had slower evolutions of breakouts by a client account. In other words, the delamination has been slower, but that's because of your community banking profile. It might also be geography related, but those tailwinds, if you will, or supporting tailwinds for a slower delamination is changing as we go into the next generation of banking. Your mid-tier and national banks, they're really starting to struggle and see that as well, where they've already seen the initial quote unquote cash sorting between today, tomorrow, and someday money, but they are also starting to realize and experience that does not mean all three buckets are within our four walls. There are pockets of expectations for better service, either in our tomorrow money or in our today money, as well as our someday money relative to what we have built out. So it is, what I would say to simplify this is, the national banks and the largest institutions have already largely felt the pains, the headwinds of the delamination. It will likely continue based on the data we see. The mid-tiers and regional community banks, they are just experiencing that kind of inflection point where it'll start to accelerate as they go down market into newer consumers earlier in their financial lives. And the fintechs are really getting hit with it head on. It's a struggle for a majority of them to understand why their customers that they worked so hard to acquire early on through distinctiveness are starting to delaminate away from their four walls.
And one more follow-up on that. Does the credit union member value prop insulate them from those trends at all, or are they also susceptible?
Now, that's a really good question as well. It insulates them to a degree, in that it is also a slower inflection point until those members who either are younger or who have grown their monetary means, they are starting to delaminate at a faster pace than the core credit union base on the membership. So it's no different than a community bank selection set.
Excellent. I think we've gotten through the questions that came in on the front section. If there are others, please feel free to enter them in the chat. We're happy to double back. But I think we'll move on now from sort of the current situation where we are, where we're starting from, to where we go from here. So the first thing that we want to touch on is just a little bit of level setting what happened last time. This is this is a very different cycle than the prior down rate cycle, in terms of starting position, in terms of pace of cutting, and obviously the last cycle ended in the sort of off a cliff drop to zero. But if we look at what happened just in sort of the very early innings, the betas were exceptionally low through the first 3 months. Basically August, September, October, with an end of July cut. And that was true on the consumer side. We've also highlighted what those look like on the commercial side as well, just in the context of managing the cost of funds across a portfolio of deposit pools within the bank. You'll notice that at the bottom of the left, the CD beta was actually negative. in the first 3 months. So in other words, CD books got more expensive, not less expensive after the Fed started cutting. That's probably not going to be the case this time, given how much further we're potentially able to bring prices down on renewals over the first couple of months, as well as the 50 basis point magnitude and the overall starting position. But we do share this as a little bit of a cautionary tale as we go into some of the specific drivers that banks will have to manage through in order to actually bring the portfolio rate down. Bob, anything you would add on sort of the early innings of last cycle versus the opening position in this cycle?
Well, since we brought it up earlier, we did get a question regarding what does this look like for private banking. We'll take it in the lens of wealth and or private banking. What's interesting is in the first 3 and 6 months of the previous cycle for wealth, a majority of the lines of business for private banking and wealth did not push down as aggressively as anticipated their MMDA products. What's really interesting is the average institution in our data set was only able to push through 48% of that downward move in the first 6 months of the 19 cycle, and that again is average. And I'm sorry, I misspoke. The average was only able to push through 24% of the downward cycle. The top quartile was able to push through 48%. So a very wide discrepancy from what I believe we hear from our clients, what we hear from the street in terms of their expectations for downward movements on interest funding and expenses this time around. So again, in the retail chair, these numbers don't exactly encourage us relative to what some of the other lines of business are doing, putting more pressure on us to make sure that we are acting surgical and not upsetting the boat, while commercial gets a little more pass through immediately, and wealth has experience already kind of passing the buck a few months before even attempting to push down on the cycle.
Yeah. Another way of thinking about this from a decision-making standpoint is what's our alternative? So for a segment of the population, it's opening a new account at the top of market direct rate. For as you move up into the commercial and wealth segments, there's dynamically balancing the bank rates versus the rates on money market mutual funds or cash alternative investments. And then the third layer of complexity for wealth in particular is balancing reinvestment into risk assets. We're still sitting on record amounts of cash in wealth portfolios relative to priced investments. And so at some point, if the market conditions align and the interest rate setting policy of the institution align, you may actually incent a little money that was on the fence between cash and risk assets to rotate back into the market. So we'll, before we move into the specific tactics for going down, we'll look at what's caused, what are the friction points in bringing rate down, and these are the same, whether you're in a plateau or whether you're in the early stages of a falling rate environment. The first is acquisition rates. So those as we noticed have come off for about half of banks. They haven't come off for the other half of banks, or hadn't up until sort of Friday data. So that continues to sort of set a mark in the market, and something that we'll want to watch very, very closely as we think about the retention risk of more or less aggressive down pricing on the back book. The second, which we sort of touched on earlier, is renewing CDs. As we mentioned, the average traditional branch bank renewing CD at 12 months is 438. That's below most of those banks top of market rate. Underneath that 438, there's a portion that's the average. There's a portion that's renewing at lower rates, maybe longer dated CDs that were originated earlier in the cycle. And so how you manage those renewals will have a significant impact on how quickly you can bring down total cost in the book. The third is the third and fourth really go together, which is this churn. So as we mentioned, the churn into the switching into CDs has slowed. It was still positive in the first half of the year while rates were flat. And if you think about particularly the liquid savings back books that are in many cases priced several hundred basis points below the on the market CD rates, there's still potential product switching pent up in those pockets as well. And then finally the acquisition costs. So as we think about all of these, there are, as we think about how we're going to bring down different pockets of the portfolio, these are some of the factors that we need to neutralize either directly or indirectly by offsetting them by greater degrees, taking rate out of other pockets of the portfolio. Bob, anything you'd add here?
No, I don't think so.
Great. What we wanted to do next is, if we think about pivoting into tactics, the first question that that banks really need to ask is do I lead or do I lag on the way down? And as we mentioned in the sort of stage setting part of the presentation, a number of banks have led, but led very cautiously or tentatively on the way down, bringing down the top acquisition rates in the market. But we haven't seen the big sort of back book cuts yet. And we're sort of watching the data in real time here, as I'm sure all of you are, to see when and how the first big public moves fall after last week's announcement. But what we're seeing is broadly a lot of tentativeness in the market in bringing down rates, and part of the reason for that is what we're illustrating on the page here. So the top row is savings, the bottom row is CDs. I'm going to talk about the bottom. The principle is the same on both. The numbers are more stark on CDs, so we'll focus on the bottom half of the page. That dotted green line is your pre-falling rate reference for acquisition and for acquisition and attrition on the left and the right, respectively. And then the different colors are lead, lag, and in line with the market. So if we start on the acquisition on the left-hand side of the page, you'll see those that led the market, bringing down acquisition costs, were very significantly below their pre-falling rate baseline, the green line. Those that aligned really didn't do any better. So if you were going to go early, you might as well have gone. Early. But those that lagged had a really significant benefit. They saw almost no difference to their pre-falling rate levels of acquisition. Now, if we look at attrition, it's the opposite story. So those that led on the way down saw essentially double the amount of attrition that they did at their pre-baseline. The green line is hitting the blue bar right in the middle. Again, here there was a little benefit for market alignment, but not a lot of benefit for market alignment. But those that lagged were actually below the line, which here on attrition, below the line is good. So they saw less attrition than they did pre-falling rates. So what's the right answer here is a pretty complicated question that's going to be individualized to each institution based on funding need and the marginal cost of acquiring balances in different customer segments that you have access to. For example, what you do on the CD book on branch might look different depending on whether or not you also have a direct bank lever that you can pull, or that or whether or not you have the ability to run off some money and retain a little bit more in for example, a commercial book. But long and short of it is there's a pretty significant cost to leading the market. There's a very significant benefit to lagging the market. And interestingly, there's not a whole lot of benefit to splitting the difference. So this is, if there's maybe one additional takeaway from this page, it's pick one rather than try and play it down the middle. Bob, anything you would add?
No, Peter.
Okay, excellent. So as we move into the specific tactics, the first is how do we manage the CD book, and there are a couple of tactical questions here. The first is, what are we doing with our on the run rates, our front book rates, and how is that going to impact our acquisition? And then the second is how aggressive do we want to be on our renewal strategy? And there are sort of magnitudinal questions across both of those, as well as customer targeting questions from a renewal tracking perspective. The second is how we manage the MMD, the back book of liquid savings. And here again, there are one of the biggest questions here is how do we pass through beta on the relatively low priced balances in the book? There's sort of traditional modeling would tell you that these are inelastic customers, and some are probably priced in a zone of indifference already. So we should be, relatively proactive in bringing down rates. The flip side of that is this is some of the cheapest money in the bank. So it requires a lot of courage in your convictions to act on this portion of the book. This is where sort of understanding the customer behavioral modeling is really critically important to how you address this, what is almost a third of the book at some banks, where there should be opportunity, but there's also some real risk. Related to that is the notion of regional pricing, which is not a new discipline for most. But the idea of really understanding your markets, and in this case, being able to price up in some thin growth markets, for example, while bringing rate down a little bit more aggressively in the markets where you have a larger back book, is a pretty useful strategy for figuring out how to chunk up the CD book and manage overall growth and cost separately as opposed to together. Before we touch on digital, those are sort of the primary rate-based tactics that we've been working with banks on and getting questions on. Bob, anything you would add to that?
The one thing I would add is just on the regional pricing aspect, especially as it relates to our question below, how do these strategies optimize NIM and balance growth for desired M costs? We're still, and we got a question on this earlier, we just deferred until this page. What does this mean for leveraging mortgage or mortgage falling rates? One of the interesting things that we've noticed is that the regional pricing dispersion across mortgage is significantly wider than that of deposits, providing larger scale regionals and super regionals, obviously nationals as well, the ability to take advantage of some relationship pricing on the deposit side alongside the asset or the mortgage, if you will, in this down rate environment. We're still in the very, very early innings, given where the majority of mortgages and HELOCs would need to be from a Fed funds or prime standpoint to reset. But we are seeing many clients start to poke at that longer term play. So 2 to 3 quarters out, what does this look like from a deposit combined with mortgage offering at the regional aspect?
Yep. Yeah, and this is probably a little bit afield from today's topic, but sort of as a related observation on that mortgage question that's come in. There's been a lot of innovation in regional pricing and more sophisticated risk-based pricing in mortgage that sat more with the IMBs than in the banking industry over the last couple of years. That is something that we've had a lot of conversations about, or how do we reposition ourselves from a pricing standpoint and from a processing and technology standpoint to deal with a strong rebound in mortgage volumes, even if that's more of a 2025 phenomenon than this quarter phenomenon. The last thing that we wanted to touch on here was just this notion of digital, and that it relates to so many different topics here. It relates to primary customer acquisition. It relates to the experience on the CD renewals, but it also is critically important to driving this market-based pricing strategy, where we can drive incremental volumes using more of a price lever as opposed to a network expense lever in thin markets. And so, as was true on the way up, on the way down, the more unique or distinct tools you have in your toolkit to fragment the book and manage the elasticity of it separately based on both the market dynamics as well as the implications to the back book and the total cost of funding will afford banks with much more latitude for how to bring rates down. So that is that's sort of the gets us to the end of our prepared remarks on down pricing. We did want to finish on just one more page, putting this all in context. But before we do that, Bob, did we have any more questions that came in? Okay. So to wrap up, this is down pricing is sort of number one on our list, probably right now of immediately topical things. To sort of tie it back to where we started, it has been a difficult several quarters from a profitability standpoint for most banks, not all, but most. And the biggest driver of that has been increasing funding costs in a flat rate environment. So turn the tables. It's a very optimistic time, I think. In terms of sort of getting back on the front foot from a profitability generation standpoint, and that will largely live and die in the near term with how effectively we bring down funding costs. That said, there's a lot else going on at the same time, so we want to think about this in the context of the rest of the business. So the other things that we want to not lose sight of are primary customer growth. If you think about that in relation to down pricing strategies, we do want to have in the back of our mind who are our prospects for deepening. Who's not a primary relationship today that really actually could be if we could just reach them the right way, and can we identify those customers with enough confidence that we can actually differentiate our pricing treatments on the way down and use price not just as a deposit retention lever, but actually as a relationship deepening lever as well. And then, of course, more broadly, how do we identify and target these customers with products and value propositions that resonate with them? The second is around, the third rather is around our investment levers. So we continue to sort of rebalance and reallocate between branch expense and marketing expense and AI, lead gen, and personalization. Those disciplines are equally relevant in a falling rate environment as they are in a rising rate environment. Next is non-interest revenue. Go on.
Just real quick, we did have a question teed up for the right size in the investment levers.
Oh, sure.
I'm going to generalize this question as we see a downward environment that does not that is not as conducive to relieving interest expense. Are you seeing institutions lean into reshaping or reinvesting in their network, either through de novos, repositionings, relocations, or leveraging marketing more?
Great question. Great couple of questions, probably. So the first is like this, this question of what sort of an environment are we in terms of relieving interest expense. I will say, I think, well, I'll speak for myself, and Bob, you can agree or disagree here live in front of our audience. The relatively faster pace of cuts relative to what some in the market had anticipated should actually be helpful to banks in bringing rates down faster. The hardest thing to do is get the ship reoriented in a really gradual, slow rate environment. Bob, I'll pause there for you to co-sign or share your own view.
No, I think that's right, Peter. I will say that one of the things that a majority of, especially the super regionals and regional banks are dealing with is watching what the nationals and largest super regionals are doing with their network and kind of constantly closing and redeploying without really losing the scale or acquisition or portfolio of the existing markets. That's not to say that this can't be an exercise that regional and community banks are excluded from. There's still pockets of opportunity within your existing footprint or within your existing network that you're otherwise not optimizing for. After all, a majority of our financial institutions footprints were built for demographics and geographies that were 10, 15 years ago. All of your markets have obviously changed and evolved throughout that period. So taking the opportunity to reposition, replace, or kind of reignite marketing in terms of leveraging the ability to drive new to bank acquisition on the periphery of your core markets are all aspects of which we're seeing the smaller and regional banks think under $20 billion explore further.
But Bob, I think you hit the second half of the question there in your answer as well, and I think it was well said. So I'm actually going to take that as an opportunity to pivot us into the next topic, which is around non-interest revenue growth, and very key to that in many banks strategies is a segment strategy, and largely one that pushes us up into the affluent, high net worth, small business segments. And there are actually some direct tie-ins to that as well. So from a banker deployment, FA deployment, there are on the one hand there are big trends towards willingness and in some cases desire to do things more digitally. On the other hand, those are segments that still where the network presence and a relationship with an individual are still very important to the overall value prop and the strategy. So as we think about how we build out the non-interest revenue levers, how we manage our branch deployments, and then how we orient our products and the value proposition around our products to align to those more fee rich segments is a pretty important driver. And then last but not least is the digital experience, both from a strictly speaking from a deposit standpoint, new customer acquisition, through managing CD renewals, but also how we leverage the digital channel to activate and deepen those relationships and cross sell into primary customer relationships. So there's a lot of work to do, and there's an opportunity for those managing deposit pricing to really play the hero in the next several months. And it's going to be a fast moving cycle at the start. Most of what's made or lost on a relative basis is going to happen in the next 6 months, in all likelihood. And so hope that some of the ideas, some of the tactics, some of the discussion around the component drivers of interest expense and customer behaviors in the portfolio will equip you to go out and take on that challenge. Bob, any final remarks from you?
No, I think the only comment I would have is I'm not in alignment that it's going to be a fast-paced cycle on the down movement, but then again, I was also surprised that we took the initiative to do a 50 basis point cut on the start of the cycle. Just watching what we've seen so far in the data, I'll reiterate, I'm not overly optimistic in the ability for this industry to push rates as far down without upsetting the apple cart as we all believe we can be.
All right. So if Isabella invites us back in 6 or 9 months' time, we can see if it was Peter's glass half full or Bob's glass half empty on the end there. But I think we're both in alignment that there's a lot that banks can do with from a tactical standpoint to differentiate performance over the next couple of months.
Thank you guys so much.
Thank you.
Yeah, thank you guys for joining us. And thank you to everyone for logging on this afternoon and listening to Bob and Peter this afternoon. With that, we will conclude today's session. Thank you again for joining us. It has been recorded and will be available on our website within 1 to 2 business days for viewing. If you guys have any questions, you all have my email and I can make sure to direct them towards Peter and Bob. If you guys would like to get in contact with them. Any closing remarks?
Just thank you to the CBA and thank you to all of you who attended.
Yes, thank you, and look forward to seeing several of you next week.
Great. Thank you guys so much.
Thank you.